Breaking news reporting live with Microsoft. Here is Benjamin, Urmi, Arushi, Juliana, Eiley, and Joshua. Introducing our reporters is Benjamin and Urmi reporting live today. In the current situation, Microsoft's core business model is the developing and licensing software PC operating systems, which includes Windows, productivity applications such as Office 365 with Teams, Word, Excel, and enterprise software and services. Characterized by the strong recurring licensing revenue, massive cash flow generation, high gross margins, and very low capital requirements, this is the core business model for Microsoft. In our current gross margins, Microsoft have high margins due to near zero marginal costs once it is written, and the software can be duplicated and distributed in an affordable manner. No significant raw materials or manufacturing costs are calculated in the grossing margins. In our functional and financial analysis, there are three areas: R&D with 16.3%, sales and marketing with 17.9%, and G&A with 3.9%. R&D has a long-run competitive advantage where it sustains product dominance, for example, Windows and Office 365, and reinforces the network efforts. Sales and marketing has a scale leverage as the percentage of revenue is not usually high relative to other companies in the industry. The Microsoft's pricing power and scale and cost leverage drives margin superiority, resulting in a higher operating margin than fellow peers. The desktop and enterprise software is also significant as it generates nearly all operating profit with high margins.
Hello, my name is Ormi Mandal, and I'm reporting from the Gaucho News Network.
Thank you, Ben. So let's look at our cash flow statements now. Why does Microsoft generate such large free cash flows relative to sales? And this is broken into two parts: margin effects and asset intensity effects. In terms of margin effects, Microsoft has a 49% operating income margin, generating $38 billion on $77.7 billion in total revenue in Q1 of financial year 2026. Gross margins are 69%, with Microsoft Cloud segment's 68% gross margin on $49.1 billion in that revenue segment alone. Operating expenses are at $15.7 billion, only about 20% of total revenue. In terms of asset intensity effects, massive asset intensity, with Microsoft committing $34.9 billion to capital expenditures for AI and cloud infrastructure in Q1 of financial year 2026. Raw operating cash flow generation is so large, $45.1 billion in Q1 of financial year 2026, that it easily absorbs this heavy physical asset spending. And the most significant effect on cash flow is seen in the cash conversion cycle, which shifted from 24.6 days in financial year 2016 to negative 17 days in financial year 2025. Strategically Microsoft leverages finance leases to defer immediate cash outflows. Only $19.4 billion of the $34.9 billion capital expenditures in Q1 financial year 2026 was actually cash paid, and therefore they preserve a strong $25.7 billion in free cash flows. This just in, Harvard Business Analysis from 2002 still holds. Microsoft's reported free cash flow is a lower bound on true economic cash flow. Cash flows combine massive profits from mature software with heavy losses from early-stage ventures like Xbox. Current margins deduct huge discretionary R&D investments that could theoretically be cut without hurting short-term profits. Core monopolies fully subsidize these early-stage losses and heavy investments. What is the ROA and ROE, and is ROE misleading here? Microsoft reported a 14.66% return on assets and a 32.25% return on equity in the current financial year. This author argues the ROE is misleading because it's an irrelevant figure that mixes apples and oranges. In another meaning, it means that the calculation dilutes the infinite returns of the operating business by combining them with the modest returns earned on a massive non-operating hoard of cash and investments. And finally, how did Microsoft use derivatives to hedge itself? Microsoft uses foreign exchange forward contracts designated as fair value hedges to mitigate currency risk on non-US dollar denominated investments. The net change in other comprehensive income relating to derivatives was a loss of $10 million for the 3 months ending in September 30, 2024. And passing it on to my colleagues back at Gaucho News Network.
Hi, my name is Arushi Aurora. and I'll be covering adjusted market value and cash flows. Thanks, Urmi. So why does the market assign such a high adjusted market value to Microsoft relative to its operating assets? This is because one of the first reasons is that Microsoft's operating assets are much smaller than their sales. The financial analysis refers to the level of operating assets as trivial compared to the total adjusted market value. And this means that they need very little operating assets and physical capital to operate. The second reason is that Microsoft has extremely high profitability. They have extremely high operating margins of 50% as well. Considering that the remaining value of the adjusted market value is attributable to the estimated future free cash flows the company can generate, the high cash flows accounts make up a large amount of this adjusted market value. And Microsoft's 1999 market estimates future cash flows at over 430 billion, which we can see on the graph on the right. And the last reason is that Microsoft is valued for a promising future. The financial analysis, the graph, points out how the multiple assigned to each dollar of contemporaneous free cash flow in recent years has actually increased from 1994 to 2000, even as Microsoft's revenue growth rate dropped. So this highlights how expectations for Microsoft future performance are strong, increasing their adjusted market value in comparison to its overall operating assets. And investors assume that Microsoft will continue to sustain high cash flows, even if their revenue drops, carried by their competitive advantage in the market and their ability to sustain high profitability and high growth. So how come Microsoft's market multiple increased even as revenue growth slowed? Typically, when a company's revenue growth slows down, investors will have that reflected in lower valuation multiples. However, this is not the case for Microsoft. Because Microsoft's able to sustain and produce massive growth in profits, even when the revenue growth is slowed, investors have a higher standard or expectation for them. And in terms of Microsoft being valued more like a traditional company or like a cash flow machine, Microsoft is definitely a cash flow machine. With the graph on the right, it illustrates that they have cash flows of 25 to 35% between 1998 and 2001, meaning they have high operating margins and modest asset intensity. And in terms of the MV over FCF, which is the market value divided by free cash flow, Microsoft is at 50 times, which is incredibly high, showing how investors expect Microsoft to remain a cash flow machine and continue to make money for several years. Now I will pass it off to my colleague, Josh.
Hello, my name is Joshua DeMolanta, and I'll be covering the comparative analysis. So today we'll be looking at the operating margins versus research and development intensity. So we see that Microsoft earns high operating margins because of structural competitive advantages and not necessarily lower R&D and innovation spending. While Microsoft spends 17.3% of revenue on R&D, it converts the revenue into 46.3% of profit, with pre-tax operating margins, which is the highest in its group. And lastly, the revenue per employee is at $531,000. Here we see that high operating margins are due to structural competitive advantages and scalability. As Microsoft impacts with Windows and Office, it reduces customer acquisition costs and increases pricing power. So here we see the Microsoft market value per employee is about $8.3 million, and previously was at $14 million per employee at its peak. Their impact in software and scalability allows revenue and profits to grow faster than their headcount. Investors capitalize these cash flows and grows market value per employee. Is this sustainable? Microsoft's dominance in enterprise contracts makes cash flow steady. The risk is rising from capital from AI and cloud infrastructure in the recent times. Keeping high returns on these fields will determine whether this valuation level continues. And lastly, the Microsoft's 9.1 capital intensity gave it a major advantage over other firms like GE and Intel, which require about 30 to 45% of sales in fixed assets. This allowed Microsoft to earn 46% margins while converting growth into free cash flow. As we see, asset-heavy firms face higher depreciation and larger reinvestment needs as they need to reinvest into their assets. As Microsoft expands cloud and AI infrastructure, the capital intensity is rising. How does this change economies of growth? Economies of growth are more independent on capital allocation, as it still operates, it keeps a structural advantage in growth economies. It becomes less software-like and more dependent on capital allocation. Passing it on to my colleague Juliana Del Mendo.
Hi everybody, my name is Juliana Del Mendo and I'm here to talk about the debt at Microsoft. So to start off, Microsoft has a more conservative structure on their balance sheet, sometimes considered ultra conservative, and this is because of its lack of debt. So before, Microsoft carried virtually no meaningful debt. In 2001, the company had no short-term or long-term borrowings, meaning that it was not debt financing in a significant way. They also had excess cash and securities. So in 2001, there was $3.9 billion in cash, $27.7 billion in securities, and $14.1 billion in other investments, bringing it to a total of $46 billion in liquid and investment assets. Also, previously in 1999, there was negative $2.7 billion for capital for operation, as well as other negative numbers. And this just means that the company's operating liabilities exceeded its operating assets. Essentially, the business model actually generates cash as it grew. So what would it look like if Microsoft decided to take on more debt? So one of the methods is a 3-to-1 EBIT to interest coverage ratio. And so for fiscal year 2025, there was $128.5 billion, and the maximum interest expense is $42.8 billion. This ends up being a total of $611.43 billion that Microsoft can take on in debt. And this just comes from the assumptions that 3 times coverage is a safe ratio. Many consider this to be a safe ratio when other companies decide to take a more riskier approach. It's also using a 7% interest rate, which is conservative for long-term borrowing, and it's also assuming that the business risk is still stable. Another approach on how Microsoft can take on more debt is the market value of the company's equity. So the market value of equity is $3.135 trillion, and the total capital is equal to equity over 75%, and the total equity will turn out to be $4.18 trillion, equaling to $1.0545 trillion in debt that Microsoft can take on, or considerably $9.33 trillion compared to its debt in 2025. And the assumptions from this number come from the market value reflects investors' assessment of future cash flows. It's not overvalued, and then remaining stable for business risk. And it's also assuming that the investors are okay with a 25% debt. And then for issuing debt and large dividends, interest deductions are a benefit of issuing debt. It reduces taxable income and lowers effective cost of capital while increasing the firm's value with a tax shield. And paying a large dividend is really beneficial for the investors because it improves the return on equity if it reduces cash that's not in use. And then it can also use the cash as a dividend for return investors and signals that the company is doing well and keeps shareholders happy and optimistic.
Hi, my name is Aili Watanabe, and I will be discussing ethics, antitrust, and economic rent, as well as synthesis and judgment. So, economic rent is defined as profit above competitive levels, and Microsoft is able to earn returns above the competitive level as they have high operating margins reaching around 50%, with free cash flow margins of 25 to 35%, which rose dramatically during their anti-competitive period, and the FCF spikes during the antitrust period also suggest excess returns. To what extent can we tell whether Microsoft's excess profits come from scale versus monopoly power? We can't precisely determine whether Microsoft's excess profits come from scale or monopoly power, as when facing strong competitors, Microsoft has failed to dominate despite spending millions, which suggests that the markets remain contestable and high R&D investment reflects innovation rather than simple rent extraction. However, the dominance of Windows produced high switching costs and network effect, which are signs of durable market power, and massive excess cash reserves supports monopoly rents. Furthermore, if Microsoft earned an extra 10% operating margin due to market power, would the author's fine calculation be reasonable? If Microsoft earned the extra 10%, they could easily pay a fine based on monopoly rents as the fine, and the fine should be based on a combination of past and future rents. Past rents are used because past illegal behavior may have already harmed competitors and consumers, and future rents are important because Microsoft position and network effects shows that today's dominance can perpetuate future rent. And is Microsoft's business model socially beneficial despite its marketing power? Microsoft business model is socially beneficial as like the standardization of Windows and Office reduces coordination and training costs across markets and wide range of availability improves productivity. Also, with their high R&D investment and rapid product iteration, it benefits consumers, and free or bundled software to certain markets, such as education, can crowd out competitors. Also, excess cash can hoard and can be used to deter entry. Furthermore, if we were a regulator, the most defensible remedy is behavioral constraints and meaningful fines. Structural breakups may do more harm than good because Microsoft's products are deeply interconnected, which reduces compatibility and slows innovation due to fragmented architectures, and Microsoft's dominant position in some markets, such as Windows, may come from legitimate scales and not coercion. However, the behavioral remedies preserves consumer benefits from ecosystem integration and prevents future abuses without destroying efficiencies. And fines also create